General advice, warning and disclaimer. Opinions, thoughts, research, recommendations and content presented are general advice only. They do not take into account your specific circumstances. Please consult a financial professional before making any investment decisions. For further information on our disclaimers and general advice, please see our website and our PDS.
Hi there, welcome to the first time we've actually had to have a sequel to the investment committee in April, but obviously we do these at the start of the month. So given the volatility, gentlemen.
It feels like we've had a year's worth of action in about a week and a half.
Well, I think we literally did overall. So yeah, we're just going to run you through essentially what we've done over the course of the last probably 4 or 5 months, really. And over the course, for the members, obviously you see the investment committees every month, and you're obviously aware that we've been concerned about the valuations in AI, the revenue not coming through in AI, and then obviously Trump coming in as well, tariff uncertainty, etc., and the fact that we haven't had a pullback in nearly 2.5 years as well. So yeah, this is one of the first ones we're going to do, obviously free to the public version. And you can sort of get a bit of an insight into what we do here in the committee. Jonathan Takadena is our resident options expert, equities experience for over 20 years. Kai, actuarial, high-frequency trading background, derivatives trading background, and myself, markets background from the mid-90s. Some pretty handy experiences come through in the last 2 weeks. I've been through four odd black swans in the last 30 years. So
yeah, I've seen a couple of those in our careers, right? So it's definitely where the experience counts.
Yeah, absolutely, and that's where obviously in this period here is where everyone was obviously thinking, what the hell do we need you guys for? And at that stage, you don't need us, to be honest. Valuations, etc., the likes of CBA, that money flow, Commonwealth Bank got to record highs, record valuations, but there was no real resistance against it. In those situations, fair call. The market does weird things and it just keeps going with momentum, right? So, and we haven't had a correction since, this is basically October 2023.
Yeah.
So, which, we did do some buying back then, but essentially we saw the Trump rally, which we thought was possibly a little bit optimistic.
Yep.
But all on the usual reasons: lower regulation, make America great again. It was more patriotism than common sense.
And then also, like, the price action around that area, like the S&P got to record highs, NASDAQ got to record highs, but it was the way it was done. It was just like, wow, they're really, really trying to push it.
And it did by less than 0.5% for 1 day only.
Exactly. So that's why it just felt like, man, if that's the best they can do, because usually beforehand, like when you bust out a new highs, it busted out to new highs. Whereas now it's like they just printed a new high by a tiny bit, claimed it, and then there was some weak price action afterwards.
And I do believe that was the day that Trump rang the bell at the New York Stock Exchange as well.
That's
So
right.
literally, since he's rung the bell, the market has not had a single positive day. It has not gone higher than that. So, look, by around about March, before we saw that first little leg down, we basically had our clients questioning what our reasoning was. To truth be told, because they're watching the rest of the market go up, and when we were largely in, like I said, 50 to 60% cash, 5% gold, 5% gold miners. Thankfully, with our resident gold bug here has made us committed to the gold thematic, and we've had a number of not only alpha trades, but obviously some large cap trades as well as some physical ETFs.
Yep. Structured products as well.
And at that stage we really, what really, I suppose, and this might sound a little bit sad, but when Buffett's going to 35% cash and holds, that was really what gave me a fair bit of confidence in that we were doing the right thing, because and he was selling down a lot of holdings. Wasn't the reason we went to it, but it's always nice when a seasoned investor like that's doing sort of a similar thing.
Yeah,
so,
and what I guess going forward, you have to realise he hasn't deployed any of that cash yet.
Yes, absolutely.
That just shows you his thinking as well.
But it just helps you sort of hold your resolve, because getting stuck in the FOMO at that point would have been your biggest mistake. And we'll talk about FOMO, or fear of missing out, a little bit later on in what we're doing next. But obviously, as we started to see the market get hit, it was very tempting to deploy some more cash at that first drop there, which I think was in March. We saw the market rally back a little bit, but obviously our first target was at 7,200, and at the time we kind of chuckled to ourselves. Let's face it, like that's what if this was going to seriously pull back, that'd be a first price target. It was a long way away, and but you've obviously got to have a plan. You've got to set the plan somewhere, and we're not going to 50 or 60% cash if we think that the market's just going to have a small downturn. So yeah, and then obviously, and we do an exercise with our clients where we set a shopping list. I mean, we've got our high conviction lists, which all the members can go and see online all the time, where we update buy zones, etc. And that forms the basis of our shopping list. But the clients also send in their own as to what they would like to buy. So that really was, the basis of the plan. And then what we're really running off here is we're using historic. You can never tell, particularly with someone like Trump, unless you're a gypsy fortune teller, you do not know how long, how deep this is going to go. But all you can really do is lean on history. So we've essentially got some examples. It's the ASX 200 on the side here. So the median fall since 2000 with the dot-com crash, the median fall is 22%. So I think we got to about 18 or thereabouts. So this was on the day before. So there was only about 4% downside left to the median. And obviously what you can see, what we're playing for here is this 1 year performance from the low. The one on the right there is the S&P, obviously 34% being the median there. I think that actually might be the average. So the median, I think, is 32. And but the US know how to bounce, right?
Yeah.
That drawdown of 17% actually got out to about 23, I believe, in the S&P. And what we're looking at as well is the days since the record high, and then what you've got on the side, the days till the low is the third column there. So basically, at that point, we've had another, say, 7 or 8 trading days since then, or probably 10 days. So realistically, that puts the date to the low in the Aussie market around July, August, and then the date to the low is around about September, somewhere in early September. So, I mean, let's just call it August for argument's sake. And that on the average of these sorts of large moves that become a bear market. So correction is 10% down, bear market is 20% down. We briefly dipped into bear market territory and it bounced out, for those that don't know the terminology. But these are the sorts of statistics we will lean on, from our experience, is because, let's face it, if down 22 or down 20 odd percent in the Aussie market, the pandemic was only down 34 at the low.
Yeah.
Fed tightening and trade war was only down 15%. Fed rate hikes and recession fears in 2022, when they started hiking rates, inflation, that was only 16 here. It was 28% over there in the US. So all you can do is really lean on history.
And the great thing is that I remember vividly, you did your homework over the weekend, came in on Monday and said, these are the actual numbers and we're buying. And basically I was like, are you sure? And it turned out to be right. And as you say, it's just based on statistics. And
bearing in mind, when I said we're buying, the least comfortable I've ever felt doing that. Like, we've been in markets, 60 odd plus years combined, and traded through some heavy things with our own money. I didn't feel comfortable, but when the media is pounding you with scare tactics and stories and God knows what, you've got to trust in the averages, and you've got to trust that, no one likes the stock market down, not governments, not feds, not anyone. So, and one of the big things as well was Trump could change his mind. So, which brings us to the next one. This was the week. So this is the NASDAQ in the week. So the Friday we came in, it obviously dropped on the Friday, and then it dropped. This was the Monday. This was the Monday morning.
That's Monday Asia. Yep.
Monday, and then this was obviously the open of the US that night. So we dropped 11%. We then rallied 10. We then dropped 7. We then rallied 13, of which 10% of that was in a minute.
Yep.
We then dropped 7 and rallied 7. So that is an impressive year of volatility. I think we had our third highest rating of volatility in history for the VIX. So and obviously buying it. This was the Monday Asia Open right there, the panic open, and obviously it's gone straight back up. And by the time the US opened, I would dare say would have been, somewhere around here, I'm assuming. But this is a 30-minute chart just to give you a little bit of context. So we're just going to run you through what we did over the course of this period. So Monday we deployed 10% of our cash. We bought any combination of WiseTech towards the end of the day, but Macquarie, Gear, and we switched our physical gold ETF into gold miners because the miners were actually hit along with the rest of the index. If you want to explain how that works.
Yeah, so basically the price of gold has been at record highs for a while. And I remember talking about it on AusBiz and talking with some clients is that at these levels, these gold miners are printing more cash than the actual tech companies at this stage. So, and the thing is they bounced a little bit, but in comparison to gold, they've definitely been lagging. And so if gold just even pauses at this level, it's gone higher. But the thing is that the amount of money that the gold miners are sort of just printing out and developing, it just means the market has to catch that bid sooner. And it did it quite quickly as well.
And in that Monday morning panic, it was sell everything mode.
Yeah.
So they actually opened down 10% when the physical product that they're selling was unchanged.
Yeah, it was down a slight bit. It dipped under 3,000 for a very small time, but that was it.
But but that is now currently, that switch was 15.5% better off alone.
Mm-hmm.
And then obviously gold's gone back to near record highs as well. So Tuesday, we did some structured investments with the higher volatility and the lower prices. They're perfect conditions for fixed coupons.
Yep.
We won't go into fixed coupons essentially, but we basically got a basket at 13% fixed for 2 years. The money's paid quarterly. They're backed by ASX stocks. Pretty similar risk profile to hybrids. If you want more information, go and check out the website.
Mm-hmm.
There's more information there. We did Goodman Group, Woodside and WiseTech because they had a 40% barrier of which they would have to go worse than GFC falls from their record, their highs to go through there. So the barrier is I think they're all 10% higher or thereabouts from the reference prices. So now the barrier is nearly 50%. So Wednesday, we deployed a further 10% cash, Goodman Group, CSL, VanEck, Global Healthcare ETF. We also bought some NVIDIA, Meta, and Citi in various different ways, and obviously that had a large spike up. It was very close to the low there, but obviously Trump talking about we were basically saying at this stage he's going to have to wind it back. China's holding all the cards.
Mm-hmm.
Or the funny one I saw was I'm holding all the cards, and then Z says. The cards were made in China. So, and then by the time we got to Thursday, we had that big rally. We bought an index ETF Gear, which is 2.5 times leverage. The Aussie on that Monday morning was the first thing we bought.
Mm-hmm.
That was the 7,200 target. Because it was 2.5 times leverage, we basically had a 10% win in the index or a 24% profit by the Thursday. And then things had started to calm down a little bit, but we got to the Friday and we had Woolworths, which actually outperformed the index by 16% over that January to April period.
Mm-hmm.
And we were essentially fairly flat on that trade overall, give or take 1%. But it had done its job.
Yeah.
It was defensive. We had it to be defensive and there was some upside in it. It would have been dragged along by the market had we have been gone up as well. But there were now much better options on the table, right? So, and you don't want to be holding Woolworths when you've got some of the best companies on the ASX and the Nasdaq and the New York Stock Exchange, for instance, available to you. We were only in Woolworths more so as a stopgap with the yield and a little bit of growth. And that we didn't want to carry anything over the weekend because that would be crazy. He could have started a war. He could have rolled back tariffs. So Monday this week, we bought more Macquarie, CSL, Goodman on the open. I think they're roughly about flat at the moment. They have been up 3%, but people as well they've bought their shopping list items that they want with their own personal preferences. But, you know, we really in these stages, we're very busy. So we tend to just try and stick to what our plan is, and then we get to the smaller stuff already. Small caps really are a little bit off the table. Gold's continued to rally, probably more so in the last 3 days. I think Newmont, our core holding, is now 35% in the money or something like that. So
it's broken out to new highs.
Yeah, so and then we've been in and out of that. So we're probably up near on 90% in those large cap gold miners over the last 12 months, thanks to this man right here. I'm more bearish US dollar than I am bullish gold, but that's how the world reflects bearish US dollar because no one wants the euro. So essentially, we've played this very well overall, and that's where our experience counted because we've lived through this with our own money. So what's next is, really is more of an exclusive members thing. You can subscribe to find out. There's the second half of this video. We do have a very, very good set plan for the next, for the coming months. So if you'd like to get in contact, obviously our contact details, invest at MPC
I will
Markets.
maybe just give out one teaser in that the volatility that we've seen, I think that continues as well. So you need to be prepared for what's coming next.
Yeah, I'm of the opinion that there's generally a second leg down, but it'll be for different reasons.
Exactly.
And you don't want to get caught in the sucker rally. And I think that, the markets have a bad habit of lulling you into a false sense of security before it goes again.
And we're starting to see that already.
And then and the second leg down will break the low of this move. So, having a plan will be absolutely imperative, and you don't want to be buying in the sucker rally when you should be selling into the sucker rally. So that's probably even more than a teaser, really. But to get more details of the plan, obviously you can subscribe, mpcmarkets.com.au, email us at invest@mpcmarkets.com.au, or you can call Dave Sebesvi, 02 7208 8002, extension 800, and find out what our products and services are. Thanks very much.
Man,